Nilesh Shah joins us now, Managing Director with Kotak AMC. Let's take our conversation forward with him. Nilesh bhai, good morning. Thank you for joining us. Earlier,
Nikunj bhai.
our day earlier would start with prayers and remembering God. These days, it starts with Ukraine and oil. What is happening in the world?
Well, the day still starts with prayer to the God because clearly we are at a geopolitical situation where anything can happen. As we speak, who know, Russia and Ukraine could reach some kind of settlement or they could escalate things further. So clearly we are at a very, very interesting stage on geopolitical side where either of things can happen for better or for worse. And as a country, we are more interested in commodity prices. On oil, we import about 4 million barrels a day. Every $10 increase on a daily basis takes away $40 million from our pocket.
So, what is in store now? I mean, 2 weeks ago, it was gloom and doom. Last Thursday, it appeared that India was in a serious position to outperform. What is in store for rest of the year? Are we likely to remain choppy the way we have moved in the month of March, where each day you have to, start fresh?
Nikunj bhai, this is the time where you will have to, you know, uh, kind of accept your limitation in predicting the future. A lot will depend upon how geopolitical situation pans out. Few things which is observable from the past 3 months, 4 months. One, FPIs were booking profit in India as it was one of the emerging market where they had money left on table. When US Fed raises interest rates, emerging market witness outflows. This time, in many emerging markets, they didn't have profit. So India was their first choice to book profit. Second, domestic investors absorbed FPI supply of more than 150,000 crore on a net basis between primary and secondary market from October 21. And now FPI seems to have turned corner. They've started buying bits and pieces over here. Uh, October 21 to Feb 22, we saw FPI selling and domestic buying. Now, going forward, if domestic and FPI both are buyers, then certainly there is more upside to the market. The third thing is related to overall economy. While oil prices are definitely, Rahu or Ketu in our Kundli, where a 10% increase in oil prices impacts our inflation by about 40 basis point, current account deficit by 30 basis point, and growth by 20 basis point. Our ability to bear higher oil prices have improved thanks to IT exports and remittances, with reserves at $622 billion. Higher oil prices can be absorbed for a longer period of time. Put all these things together, markets have mostly remain in a range bound fashion between, let's say, 16,500 Nifty on the lower side and 18,500 Nifty on the higher side. Today, we are somewhere in the middle. So a lot will depend upon how geopolitical situation pans out, how commodity prices moves out. And this is the time where one will have to, accept the limitations that we are in no position to predict what's going to happen in Russia and Ukraine, and hence impact on commodity prices.
Let's address the viewer who's watching the show. And the conventional wisdom on the street is high oil prices is bad for macro, high commodity prices is bad for margins. Net net, the way things are moving on the commodity front, we are in for an earning disappointment. And markets, in a sense, right now are still in a denial mode because they are not pricing in that kind of a disappointment. Is this consensus which a lot of retail folks have? Is that true?
So, Nikunj, a counterpoint to that is that this oil prices are transitory. As they say, remedy for higher oil prices is higher oil prices. As commodity prices remain elevated, new sources of supply comes up, demand destruction happens, alternatives emerge, and eventually commodity prices come down. Yesterday, I was seeing on Twitter one chart which shows how oil prices have moved up And clearly, they have jumped up significantly in a short period of time. This is kind of, let's say, 10%, 10 decile of price movement. And clearly, at that point of time, it is fair to assume that these prices will not remain elevated for a long period of time. As I mentioned, tomorrow, if there is a solution between Russia and Ukraine, the immediate impact will be on oil prices. Likely scenario maybe market is looking at is that alternate oil supplies from countries like Venezuela, Iran starts emerging, and Russia, who is right now under sanction, also probably leaves OPEC cartelization and starts producing oil in order to rebuild their economy. If that happens, we are looking at oil surplus impacting oil prices rather than oil deficit, keeping oil prices higher. But these are all realms of possibility. What will happen is today beyond our ability to predict.
Good morning. This is Nantara who's joining in. So when we're talking about that, we've talked about crude. You've touched a little bit about commodities, right? Steel prices, they're going up. Europe may introduce the sanctions. We know Russia is one of the world's largest producers of steel. You're seeing a rub-off effect on edible oil as well, just because of the way Ukraine, dominates as far as the global supply solution goes. How will that impact the equity markets and stocks in particular, like consumer staples?
So, Nayantara, if we look at the consumer staples, they are facing twin problems. One, there has been a softness in demand. And second, there is a hit on the margin because raw material prices from wheat to edible oils to other ingredients, including sugar, has gone up. Now, in this kind of scenario, clearly the high valuation which they were enjoying is coming under pressure. And we believe consumer staple is likely to remain underperforming to the market, partly because of higher valuations, which have started correcting, partly because of the softness in demand, which we are witnessing, and which may start recovering if commodity prices starts coming down. And third, their ability to pass the price rise of raw materials, which in today's scenario may look a little bit circumspect. So overall, consumer staple, bearing few exceptions, should remain underperforming to the market. The commodity sector like steel should do well, especially as steel prices are likely to remain elevated. We have seen Europe's biggest steel plant in Ukraine getting impacted as per the news reports. Now that's going to hit the supply. And the demand for steel should remain elevated, keeping prices on the higher side.
Could be a good time for steel exporters too, especially if sanctions come in for Russia, the way Australia this morning is also talking about. Nilesh, we're saying that it might be too late to sell, right? Even if you look at the week gone by, the Nifty did rebound 4%. You saw FII flows also start stabilizing. However, if one were to see the bond market, and I was wondering if you could help us understand this, that seems to indicate that we might be in a bear territory. We did see the inversion of the 5-year yield and the 10-year yield also last week.
So normally we have seen in US market that when oil prices shoots up significantly in a short period of time, it is harbinger of recession. 7 or 8 out of 10, it results into recession in US economy. Inversion of yield curve also is harbinger of recession. And there is small but a very knowledgeable portion of community which believes that Fed is unlikely to raise interest rates 7 times. In fact, after few rises, they may have to resort to cut to support growth. Now, again, they are significant minority in this kind of assessment, but it shows the thinking of the street, which believes that US Fed rates are not going to move in a straight line. They may have to come down in order to take care of economy. If we look at Indian point of view, our 10-year yield has now ranged between 6.5 and 690 for quite some time. Our yield curve is discounting RBI's potential action. At current spread, we are probably above historical averages by a reasonably large margin. And we believe our 10-year yield today discounts about 4 to 5 repo rate increases by RBI. So our markets have discounted RBI action. And in US market, the markets have shown curve inversion to kind of negate what Fed is proposing right now or indicating right now. It's an interesting situation. Undoubtedly, Fed will bother about economy ahead of midterm election, ahead of oil shock, ahead of curve inversion. Whereas in India, fixed income markets are discounting RBI's rate action. So hopefully, when RBI actually starts raising interest rates, there will be limited impact in our fixed income market. And we have to hope and pray that Fed does not end up overshooting on raising interest rates.
Nilesh bhai, how do you see the first half being different from second half? Because somewhere energy shock will adjust. Somewhere we will get a clarity as to where central bank policy action is going to move. Today, what is headline is crude and central bank policy action. Towards the second half, hopefully that is something which markets would have clarity on. Now, once you get clarity, prices will adjust and the template of the market will move. Will the first half of this market or second half of this calendar year be completely different from the first half?
Undoubtedly, Nikunj bhai, our hope is that second half will be far more calmer compared to first half. First half has witnessed tremendous volatility, but to a great extent that has been absorbed thanks to domestic investor participation. We believe in the second half, domestic as well as foreign investors will be buyer in the market. Uncertainties around crude and commodity will be behind us. And at that point of time, IPO pipeline would have begun. And that supply will be kind of capping the market rise. But that supply will be at higher valuations, more supply will come. At lower valuation, less supply will come. So it will be kind of counterbalancing. So in the first half, geopolitical event is dominating market. Hopefully in the second half, it will be economic fundamentals and IPO pipeline, which will dominate the market.
We spoke about mid and small cap stocks, how they were expensive, and the cycle was nearing its turn. Now we've seen a sizable correction, 15 to 20% correction. If you are 15 to 20% is the average correction, even after the recent comeback. Is it time now to start looking back into small and mid cap stocks?
Nikunj bhai, a lot will depend upon how geopolitical situation keeps commodity prices higher. Many of the small and mid cap companies are consumer of commodity, and they don't have ability to pass the price rise like the large cap company. So in our small and mid cap strategy, we are focused more upon market leaders. Even in small and mid cap companies, we have companies which are leaders in respective sectors, which have large market share, and they have ability to pass price rise, if not fully, at least partially. So right now, in this kind of commodity cycle, we are trying to invest in companies which, apart from having market leadership and good management, also has ability to pass the price rise, also has ability to move or protect their margin. And if this criteria meets in your small mid-cap allocation, one can look to start accumulating at current level of valuations.
A lot of debate, Nilesh bhai, that how come Indian domestic mutual funds have such a large kitty? It is almost like an endless kitty where every time FIs are selling, they are buying. But do you think rather than calculating the number at the SIP, we should also recognize that this is balance fund money which is coming? Because I'm thinking that how come mutual funds have so much of cash? Every time FIs are selling, they're saying, thank you very much. We wanted to buy that share. You're giving it to us now.
So Nikunj bhai, over last 20 years in mutual fund, I have seen FPIs buying and mutual funds or domestic investors actually selling. While our AUMs have continued to grow as a percentage of GDP, as a percentage of savings, it has not grown as materially as absolute numbers. And it's a matter of pride now that in a crash like March 2020, domestic investors gave us money so that we could buy from FPIs when they were selling. Again, thankful to retail investors who gave us money all throughout October 21 to March 22 period through SIPs, through lump sum consideration, whereby we could absorb FPI supply. And undoubtedly, there is a fairly large balance advantage fund money, roughly about 2 lakh crore in size. In this kind of funds, we buy more when markets are cheaper, and we book profit when markets are expensive. Those funds have also increased their allocation in this correction. So we are all thankful to the retail investors who have given us money, not only through SIPs, but also through products like Balance Advantage Fund and Asset Allocation Funds, and also in lump sum to absorb supply of foreign investors. But at the end of the day, foreign investors are even today 2.5 times our size, and we have a long distance to cover.
How much is that money which you think is potentially on the sidelines? Because this is going to be in comfort tech number. What comes out of your mouth now in terms of a number will get headline. So you may want to pause and think. What I'm trying to understand from you is that how much genuine money is there on the sidelines with mutual funds, whether in form of cash or in form of money coming from balanced from debt to equity, which in a sense is going to be there as a safety cushion when FIs are selling.
So, Nikunj, if you do broad thumb of rule calculation, about 11,000 crore is SIP flow on a monthly basis. You can assume about 10,000 odd crore coming by way of lump sum, including in balanced fund. So roughly about 21,000 crore will be available on a monthly basis with domestic mutual funds to absorb FPI selling or IPO supply. You can add on this insurance money, pension fund money, EPFO money. If you look at products like Balance Advantage Fund, there is a reasonable portion available, but that will be purely linked with the market valuation. At every lower valuation, there will be increase in Balance Advantage Fund allocation to equity. As we speak for ourselves, our Balance Advantage Fund is about 13,000 odd crore in size. And today, let's say it is 42% invested in equity. If market continues to fall, I can increase it up to 80%. So you can imagine there is a reasonable amount of reserve in Balance Advantage Fund. But excluding that, roughly about 20 to 21,000 crore a month will be coming into domestic mutual fund kitty to invest into the market.
So अभी डरने की जरूरत नहीं है. If FIs are selling, we should not look at that number. There was a time when they would catch cold and markets would sneeze. Now the real heroes are Indian investors.
Undoubtedly, Nikunj Bhai, the maturity of retail investors has been absolutely superb. Throughout this October 21 to March 22 correction, we have not received a call from an investor about why markets have corrected. And at every correction, we have received more flows. So it's all kudos to the Indian investors' maturity. While one doesn't have to be afraid or fearful of the market, there's no harm in being cautious. There's no harm in following the dharma of asset allocation. This is the market which is fairly valued. One should be equal allocation to equity, not leverage, not overweight, keeping in mind the long-term India growth story. This is time to be equal weight to equity market.
We get a promo bite from Nilesh Shah for my other media friends also about thanking media for what they've done.
Undoubtedly, Nikunj Bhai, this journey would not have been possible without your support. The way, during correction time, you have convinced Indian retail investors about long-term growth story. That has changed the narration. Today, when we meet retail investors in every nook and corner of India, they are far more informed. In fact, the information asymmetry, which was there earlier, has now totally disappeared. People are more knowledgeable, they are more convinced. And that's where even when COVID-19 kind of situation happened, based on comments made by anchors like yourself, people have used that opportunity to buy rather than panic and sell. So it's all thanks to your wholehearted support.
Well, thank you very much. It's just been such a pleasure tracking markets, and I just feel so proud that in this bull market, it's not the promoters and the foreigners who made money. It's the rise with India, the average retail investor, who've really benefited because of this rise in Indian economy. I appreciate your time, Nilesh Bhai, and thank you for joining us.
Thank you so much.